Hello and welcome to the second day of our first ever Alternative Investment Week. It's fantastic to see you all logging in to join us. My name is Sally Kramers. I'm head of events here at UKSIF. I'll just be running through a few things before we start. Firstly, a big thank you to our supporting partner, AIMA, the Alternative Investment Management Association, for helping us get the word out about this event. Secondly, all of the sessions this week are live and interactive. You can ask questions in the Q&A tab at the bottom of your screen to get involved in the conversation. All the sessions will be recorded and made available at the end of the week. That's about it from the housekeeping side of things. So without further ado, I'd like to introduce my panelists. We have Peter Bachmann, who's the Managing Director of Sustainable Infrastructure at Gresham House, Carmela Mondino, Head of ESG and Sustainability at Partners Group, and Danny Riding, Senior Counsel Financial Services and Markets Department at Travers Smith. Peter, will you start us off by saying a few words about yourself?
Yes, hi, I'm the Managing Director of the Sustainable Infrastructure Division of Gresham House. To help you place us, Gresham House is a £4 billion specialist asset manager, and I manage our British Sustainable Infrastructure Fund, which is a £340 million strategy backed by 7 local authority pension funds.
Perfect, thanks Peter. Danny, can I pass over to you?
Sure, I'm Danny Riding. I'm a Senior Counsel in the Financial Services and Markets team at Travers Smith, and I have a specialty in ESG for financial services and markets participants.
Perfect, thanks very much. And Carmela.
Thanks, Sally. I'm Carmela Mondino. I'm head of ESG and sustainability at Partners Group. We're a private markets investor with over $109 billion assets under management, investing in private equity, infrastructure, real estate, and private debt.
Perfect. Thanks very much. We will dive straight into the questions. What are you seeing as the biggest investor demand when it comes to ESG in private equity? Carmela, I might start you off on that one if that's all right.
Yeah, definitely. Well, I mean, I think there are a couple of things, and I would be keen to hear what Peter and Danny have to say about that. But when it comes to themes, there's definitely climate change and diversity and inclusion that have emerged as the main topics that I see demand for. This is driven by different things. As you know, well, climate change is on top of everyone's agenda these days due to the things that we all are seeing and suffering, I would say. And then especially coming from the States after the events last year, I've seen definitely an increase on diversity and inclusion questions and interest from our clients. Now, when it comes to more, not themes, but actually more process-related topics, I think overall people are interested in more transparency. And I know in the UK you've had different frameworks that have asked for or pushed for more transparency for a while, but we're seeing this also emerging even in places like where it was not a topic, again, like the US. In the EU, we have SFDR, right? So basically people are thinking more around, well, you know, you're talking about ESG, but you need to be concrete in demonstrating that you're having an impact and actually transparent in the way that you communicate around it. So that's my first crack at it. I don't know if there's anything Peter or Danny would add to that.
Yeah, I think, Carmela, you're right on the money. I think for us, all of our LPs are talking about net zero solutions. Yeah, they really want to understand how they actually get on top of this, because a lot of their member base are asking for, what are you doing? You know, these are people's pensions, and they actually want to see that this is being used for good. I think now more and more those allocators are being a bit more, well, they're understanding the market better and realizing that actually buying secondary assets doesn't create additionality. Yeah, so we are seeing now more of an interest in greenfield assets to build them from scratch, because actually if it's already there, you can't then claim that it's creating carbon credits or the like. So I think there's more growing awareness of that. And I think the transparency, you know, we're having a lot more conversations with our investors now. They actually want to work through, what are the KPIs that you've got for your individual assets? You know, what are you measuring? How are you monitoring it? And I think that level of sophistication is really encouraging, because I think that will now drive change. I think the thing that we see most is that for so long, ESG has unfortunately been a bit of a box ticking exercise. And I think people now recognize that can't go on, and we do need to start to make change, because, you know, the warning signs are all around us. And I think people are very attuned to that, which is great.
I think I completely agree with that. The picking up on one of the points that both of you have made, one of the things I'm seeing is a marked uptick in investors requiring ESG data from their PE firms in relation to the underlying portfolio companies in order to help the investor discharge their own obligations, which is just another take on, I think, what's that point that's been made already. But a good example of this, I think, is a forthcoming development in the UK pension space, for example. So earlier this year, the UK Department of Work and Pensions has published draft regulations for UK pension schemes, which, amongst other things, is going to necessitate the trustees making public disclosures about steps that they're taking to assess and manage climate-related risks and opportunities in line with the TCFD. Now, that's an investor change. That's a change that is going to require action by trustees. But naturally, what you might see and what we're already beginning to see is investors pushing those obligations onto their managers, because ultimately they need the ESG data in order to meet their own obligations.
So do you think that the sort of disclosure regulation is the main cause driving the rise of impact-focused funds?
I don't think it's the main force. I don't think it's the main force driving the rise of impact-focused funds. I think it is definitely a part. So take EU Sustainable Finance Disclosure Regulation, take the EU Taxonomy. None of those are requiring managers to do anything positive with respect to people and planet in the pursuit of profit. They don't do that. But what they do is they shine a light. And same with the new FCA proposals with respect to new climate-related disclosures that asset managers are going to need to make in the coming years. What they do is they shine a light on behaviour. They prevent you from greenwashing. They make you, they make you stand behind your ESG claims. And following that kind of spotlight, naturally that creates a shift in behaviour, because firms are going to want to have a good story to tell the world and to their investors, and that will encourage competition in the market. And I think that is a factor behind the rise of several large houses. I'm thinking of the kind of Apollos, TPGs, the Bain Capitals, the KKRs, all of these big, large public funds all of these big, large funds that we're seeing raised over the last couple of years. Disclosure is definitely a factor, but I think for all of the reasons that Carmela and Peter were saying before, it is one factor amongst many. And I think if you are being driven solely by regulatory change, then I think you're perhaps behind the curve.
Yeah, I mean, I think when you think about it, ESG disclosure regulations are around how you do business, and that can have, that can be about any kind of business, and it's basically just making sure that you're being responsible with the environment, with your employees, and so forth. And like Peter said, basically, pension funds are just realizing that there's an impact beyond that. When it comes to impact funds, there may be a connection, because I think what more transparency creates is more accountability. But I do think that there is a common theme in the sense that, people just realize that there's more to their money than just the financial returns. And ideally, everyone does business correctly, but also you contribute with solutions to the big problems that we have in the world, right? I think everyone needs to save energy, but and that can be done by any business. But ideally, you also develop renewable energy sources so that the whole system can become more sustainable overall.
I also think it's being driven from the customer side as well. So I think personal pensions are being allocated and people are trying to make decisions consciously. But also, we've got a project that takes commercial and industrial waste and turns it into a pellet that can replace coal and the cement or the steel industries. And we're getting a big push from customers in the steel industry, where actually they're saying that their car customer type customers are demanding low carbon steel. So it's coming from both ends now, I think, where you have a genuine demand for new products and services that are sustainable. And then therefore you have a requirement for capital, which kind of then brings in capital that wants to consciously commit to these sort of new challenges. So I think we're at a great point now where clean tech 1.0 was probably a bit too early. There wasn't really the customer push as well, and the governmental push. Whereas I think now we're in this next phase where actually innovative new solutions is going to be a big driver for financial returns as well as customer demand. Like I think if you're not doing this, you're going to have stranded assets. You're also missing the opportunity to create really highly valuable assets.
Well, but I think that's what it makes it even more interesting, because back in the day, and I would say even 5 years ago or even less, we would get in the question, does ESG mean that you are jeopardizing your returns? And there was always this question around the fiduciary duty, right? But if you actually see sustainability as something that brings business opportunities and that you can capitalize on, which is what Peter, I understand you're saying, then there's no trade-off. And that makes it even easier to do the right thing.
Yeah. Well, if your business or your asset isn't profitable, it's not sustainable. Yeah, you end up with a charity, which isn't what we're here for. And I think, yeah, Carmela, you're exactly right. I think people are now starting to see that this is a investment strategy. Yeah, in the public markets, yeah, those stocks that have had any sort of ESG linkage have performed incredibly well. And I think, yeah, if you look into the private markets, they have an opportunity to do even better. And yeah, they are more pure focus in what they're trying to achieve.
And what is the difference between an ESG strategy and an impact strategy, if you sort of get down into it?
I figure others might disagree with me, but I'm happy to go first, which is whenever I try and answer this kind of question, the first thing I go to in my mind is the Bridges Capital Spectrum of Capital, which is quite a well-known document. But what I think that neatly encapsulates is ESG and impact investing are on a spectrum. On one extreme of that spectrum, you can have a manager with zero regard for ESG practices, not even as a means of protecting value, which is something I haven't really seen in private markets, if I'm completely honest. But at the other side of the spectrum, you've got a manager which is not seeking a financial return, which is, as Peter mentioned a moment ago, basically a charity. To my mind, ESG and impact investing sits somewhere in the middle of that spectrum. And so if I take ESG first, I think it has historically been focused on mitigating negative externalities, the negative consequences of our investment activity in order to preserve and protect value. And I was thinking about how I might explain this, and I thought an ESG strategy might, for example, a fund pursuing an ESG strategy might not decline to make an investment which has a negative impact on the environment. It may proceed, but it would seek to, I think, improve that investment's ESG credentials as a means of protecting its value looking forward to an exit, because it believes that sustainable investments may lead to an increase of value on exit. And that might be done through kind of implementing energy efficient practices, prioritizing the use of recycled materials, and addressing human rights issues in the supply chain. So that's what I think of as ESG, is that kind of negative externalities. And I think of impact investing as something which is different, where there is much more of a focus on intentionality. The fund intends to have a positive impact on the environment or society. And in the PE space, as Carmela and Peter were noting, also seeking competitive returns. If you look at kind of, for example, some of the recent public press about the BlackRock Global Impact Fund, that talked about having different, 3 different key impact criteria there. It's got to have materiality, which means that the majority of the return has to be it has to achieve something pursuing the UN Sustainable Investment Goals. It's got to be measurable, quantifiable, and a bit less commonly I see in the impact space, you've got to have additionality, which means it's got to kind of deliver a new technology or innovation. And it also, because we're in the PE space, has to seek a return. So that's what I see as the difference, accepting that it's up for debate and accepting it's all on a spectrum: ESG, negative externalities, impact, intentionality, in the pursuit of what's sometimes called the triple bottom line of people, planet, and profit.
I mean, I really like the image of the spectrum. I do have to say that I would define them slightly different. They're definitely one next to the other. But in my opinion, ESG is not only about the risk mitigation part, but also in part a bucket that I think Danny put closer to the impact side, which is around capitalizing or creating value from ESG topics. I think this is important because, I mean, anyone has to work on things like, on modern slavery, and this is definitely a risk that everyone has to mitigate. But then when it comes to, you don't need to be an impact investor to actually start thinking about, well, how can I make the lives of our employees better? And this is not from a risk mitigation standpoint, but simply from saying, well, I want to be a more sustainable business. I want to do the right thing for society. And this will ultimately, and even linked to what Danny said, make a better business. And at the end, I will make money out of it when I exit, because, I will have happier employees. I will, they're going to be more proactive and so on. I don't think you need to be an impact investor for that. And then I totally agree. Ideally, if you think about this in the ABC framework, the A is the avoid the harm, the B is the benefit of it on the solutions, and then the C is contribute to solving the problem. Ideally, impact falls into that bucket. So slightly different, but in the same neighborhood. Peter?
Yeah, I agree. It's all a spectrum. I think where it's changing for me is that, in my mind, impact used to be you'd sacrifice returns for some of these external outcomes. And I think what's changing is, as you said, Carmela, that people are now seeing ESG and impact in some respects providing business value. And actually, I think the blending of impact and ESG will become, or the blurring of that will become more pronounced, because basically the only allocators to a pure impact fund where you are sacrificing returns will eventually be endowments or charitable organizations that are trying to achieve a different type of outcome. But anyone that's financially driven, investing into impact, I think we'll need to start to see it as an opportunity. The way that we look at our funds is that they create these great externalities, but actually they drive good financial returns as well. And in my view, I think that is going to blur back together, except for a very small outlier pocket of funds that probably don't think the way that we do. Well, this panelist would think about funds.
And how do you start, like from the beginning, embedding ESG and impact into your private equity strategies? The big question, I'm afraid.
Yeah, look, for me, the way that we think about it is actually to work backwards from the big environmental and societal challenges. Because if you can find those things that have got big macro tailwinds driving need for change, we think that providing solutions to those could have some very large financial outcomes. So we don't really think about it in ESG per se. We think about, okay, for example, we look at resource efficiency as quite a big vertical of opportunity. And we're investing quite heavily into vertical farming, where that project, the first project we've got, uses 95% less water. We can grow in 4 acres what it takes 1,000 acres to grow on the field. Virtually no food miles. The produce is grown in a food safe environment, which means that when it lands on the shop, it doesn't need to be chlorine bathed a number of times. So the shelf life goes up 10 days plus. So these are all really quite, I think, great pure outcomes that create good ESG type benefits. And then as part of that, you have to embed all the other things around diversity. We think that diversity is actually a driver for value. Having diversity of thought, diversity of approach and background is additive. It's not something that should be an afterthought. And I think that's the evolution now of this ESG movement, is that it's not something that you do to sort of almost backwards looking justify what you've done. The way that we think it's got to be as a value driver. And so I think it just becomes naturally part of everything that you do.
Yeah, I think that's a good point. And I think it's fair to say that when we start thinking about ESG in our investments, there are definitely some topics that are common to any kind of investment. But in our case, besides from using ESG to identify investment opportunities and also to exclude some, right? Because I think, Peter, it was you that mentioned that, you may end up with strained assets if you don't think about ESG topics, right? I think what is important, especially during the due diligence phase and during the ownership period, is to insert the concept of materiality. Everyone has to think about climate change and diversity these days. But when we think about a specific business, I think it's still important to think about, well, what's going to create the most value or mitigate the most risk to prioritize. ESG, it's too broad. Sometimes it feels like they just put all the things that didn't belong anywhere else and they just group them in one sector, right? So you still need to pick your battles. For us, when we're looking at an investment, it's still important to start, to put this lens to really focus on what's going to make a difference. And then during ownership, actually, I think what's interesting is that in private and very specific to private markets actually, is that we can start with a G. Because we are going to be able to set up the boards of these companies. We're going to be able to engage with them directly because we have this privileged position compared to listed markets where you're one of many other investors, right? So you can set up the right governance structure to really push for ESG topics and address, other G, but also E and S in a more effective manner. And as I said, really prioritizing what counts for the company. So at least I think that's something that is particular. Materiality should be there for every kind of investment, but for private markets, the governance part, it's particularly important.
I guess I think both of you are probably closer to this than me, and what I see is just a more, in practice, is just a more bird's eye level approach of kind of how a PE firm seeks to embed ESG into companies. And so, from my perspective, what I see is during an acquisition process and then after acquisition, I see the head of sustainability, the general counsel, compliance working with the portfolio company to do things like issue guidelines to them to set out what the house hopes to achieve during the life of the investment. To the extent the portfolio company hasn't got it already, seeking to develop an ESG policy and some kind of reporting framework to make sure that there's that active dialogue throughout the hold period. And I guess that's what I would call the paperwork. It's an exercise in seeking to understand and then mitigate rather ESG risks, but then enhance ESG opportunities. And then throughout the life of the investment, that reporting framework is operative, but PE firms will often have the investor director there. And so I think they can often be used as an influencing factor just to continue to make sure ESG goals continue to be achieved. And in some cases, PE firms may have in-house sustainability resource, such as a head of ESG and sustainability. And I have seen them working quite closely with the portfolio company too and providing kind of assistance and support. But as I say, I think probably a more bird's eye view than Carmela and Peter.
No, but it's spot on. I mean, this is exactly what I meant by setting up the right governance. You put the right foundation, and ideally you take a picture, and this is what we do with our assets. We take a picture of what the company looks like when we make the acquisition, and then we know what it should look like when we exit, right? And then it's about, as you said, through the ESG team, at least in our case, but also empowering the companies to do so and giving them the right resources or assigning the right resources, making sure that they can get to where they're supposed to be, in 5-7 years time.
Perfect, thank you. And we also have a question from the audience, Danny, that I'd quite like to aim at you sort of along this topic. Since the announcement of TNFD, have you seen any alteration in ESG considerations from private equity funds? Oh, you're on mute, I'm afraid.
Sorry, I should be better at that by now. I think that probably is meant to refer to TCFD, and I think that might be a reference to the recent FCA consultation paper about TCFD disclosures that asset managers are going to need to make in the UK. What some people are recalling the UKSFDR, i.e. something that's slightly different. And I think right now, I would say, no, I haven't seen any kind of material changes in approach. I think the UK response or thought process in relation to SFDR has just taken a little bit longer to develop. And we're only at the consultation paper stage right now. So no, I haven't seen any material response in the last few weeks. UK asset managers, despite Brexit, have found SFDR to be hugely relevant to them, either because they have locally licensed EU affiliates or because they are continuing to market funds into the EU. That, I think, has been a huge response, but I suspect that's relatively obvious. So more focus on SFDR, more focus on what firms are looking to achieve with their next fund, less focus on TCFD right now, but that's only because it's in its early stages. I think that will be enormously important for UK managers over the next couple of years.
Perfect, thank you. And Peter and Carmela, what metrics do you use to measure ESG and impact?
Well, I mentioned a few earlier in terms of our vertical farming business. Generally, on everything that we can, we try to boil it down to a carbon figure. Because ultimately, most actions apart from the G side can probably be measured in carbon. So we certainly try to boil it down. So for example, I think I mentioned that project where we take commercial industrial waste and turn it into a pellet. In that case, we've measured that we've got avoided carbon equivalent to 678,000 tons of CO2 per year. So that's a big stat for us, pardon me. And that's the sort of thing we measure. Other things we measure are absolutely the level of diversity before and after our investment. So we do want to see how many people they've actually taken on to improve diversity. What have they done in terms of board diversity? What have they done in employee diversity? What have they done to actually change the way they hire? We really want to see that. We look into the supply chain. What have they done to actually check the supply chain logistics within that business? Quite a lot of our businesses, we insist now that they do complete supplier reviews before we invest. What have we done in terms of logistics planning? Can we make sure that, so a business, that we invested on our venture side recently, which is a logistics planning business, they insisted to actually add in a low carbon or zero carbon option into that business. So it's all sorts of different things to try to actually create tangible effects. And as I said, every single one of those will have KPIs, and we'll go measure and monitor them every year and report against them.
Mm-hmm. Yeah, I think on the impact side, our approach is quite similar. So we try to have, but in our case, we try to have metrics that speak to the business model of the companies. So we would have carbon-related KPIs for more environmental investments, but we would have also things more on the social side for, let's say, healthcare, education, and things like that. I think on the ESG side, we also have a set of KPIs that speaks to the business model, again, linking to this concept of materiality and what are the main areas that we want to focus on. But then we have defined, because until SFDR came out, there was no set of KPIs that you would have for an entire portfolio. So we had to define it ourselves. So we defined 12 KPIs with different degrees of materiality for each investment that we track for all our investments. And now what we are doing, and it's proving to be a huge exercise, is to compare our KPIs against SFDR and against all the other frameworks there, and just come up with a comprehensive way of looking at things. I don't think we're ever going to walk away from the company-specific KPIs, because you're never going to be able to have something that speaks to every kind of business model, right? But at least we are actually welcoming on the ESG side to have one set of metrics that everyone has to report on. And well, carbon is part of them. Sure. So that makes it easier, or hopefully will make it easier to compare investments in that regard as well.
I think that's really interesting, because what you've just articulated is what I see, which is KPIs now fall into two overly simplified buckets, which is standardized KPIs, like I suspect you have in mind things like the principal adverse impact KPIs under the SFDR regime. But what I see firms doing with metrics is, yes, depending on what position they have taken in relation to SFDR, depending on their structure, etc., yes, they'll have regard to that huge set of KPIs that comes with that whole regime, but they, firms are still needing the flex to develop their own KPIs. And I have in mind here things like Article 8 funds or Article 9 funds under SFDR, being those which promote an environmental or social characteristics or have a sustainable investment objective. A lot of the legislation and draft rules here are unclear, but I think certainly in respect of those funds, there is, or at least my read of it, is that there is an acknowledgement that firms will develop their own KPIs, because they will look at what that fund is trying to achieve. They will look at the characteristics it's trying to promote, for example, and they will think, okay, how can we measure that? How can we measure the characteristics that we have set ourselves? And ultimately, there's only so far that standardization can go in respect of something like that, because funds are individual, strategies are individual. So yeah, I think that's really interesting to hear that.
That's the problem. Once you start getting into quite specific or bespoke solutions, it's almost impossible to try to standardize how you approach reporting against them. And I think that's the I guess the dichotomy of this sector, is that I think a lot of us want standardization across a lot of things, but to some extent you just can't. And that's, I think, something that we're all going to have to grapple with. And I think the good thing is that we're all talking about it now, which is a start. But undoubtedly there are too many standards out there now already. And undoubtedly, that's, I think, as an industry, what we're going to try to do is to bring it back to something that people can understand. We've been thinking about, can you create a metric that says, okay, that's the equivalent temperature increase. That whatever you're doing, that's worth half a degree up or half a degree down. Trying to boil it back to almost the label that you put on the back of food, such that people can understand what they're getting into. Would be great.
Yeah, and it's a bit of a tricky situation, right? Because everyone is developing their own frameworks. Ideally, we're going to be able to standardize them. And having these frameworks is starting a lot of these conversations, right? But at the same time, you want to focus on actually getting the metrics from A to B. That's where you are going to, create change. So I hear you. I think it's these are important conversations. We should have them. But I really hope that we're gonna, get through them soon, and we're going to be able to continue doing the impact part, which is the important part.
And sorry, Peter,
I was just going to say, and the good thing is I think people are now focused on the impacts, and I think if we keep focusing on that, then the reporting and what have you will hopefully catch up at some point.
Perfect. And sort of tying into all of that, there's another question in the chat box. Do you find it difficult to source ESG data? If so, how do you sort of overcome some of these challenges?
It's a really good question. I mean, on the direct side, you can actually work with the investments to try to, set up these frameworks and get the right systems in place to gather the data. But when it comes to potentially an investment in a fund, and if the manager doesn't work actively with the investments to get that information, then it's really hard. And as part of SFDR, if you want to be an Article 8 and you want to push the conversation, you need to gather that. And in the private market space, it's not that easy, just because the companies are totally different from what you would expect in the public sector. So it is a good question. I think unless you work closely with the investments, it's really, really hard. And I would begin to hear about a solution. So if anyone in the audience has figured it out, that would be interesting. But it's just because it's, Scope 3, for instance, it's really hard to calculate for an individual investment. It really depends on the business model and their own supply chain and so on. So how can you estimate that? It's something that we still haven't figured out for the companies for which we don't have a direct influence in.
Yeah, I can't echo what you said more. We're certainly very much more a direct investor. In our public market strategies, yeah, it's a lot harder. I don't think anyone has quite gotten on top of that yet, because as you say, Scope 3 is almost impossible to measure unless the underlying company is doing it themselves. Otherwise, you're just making random assumptions. So it is still a challenging area, and that, I think, is why the private market in a lot of respects is a purer form of trying to achieve some of these ESG outcomes. You are able to measure, and as Carmela said earlier, you can put in the governance and the structures that you need to actually ensure that this stuff does happen. Whereas the public, if you're investing into a public company itself, you have virtually no control over them. And that's, I think, the big difference between public and private markets approach in this area, is that you have so much more control in the private market.
Perfect, thank you. And what makes ESG so crucial in private equity? Danny, I'll pass this over to you to begin with, if that's all right.
Yeah, sure. I think there's many different answers to this question, but one that I keep coming back to is, I think ESG represents a huge commercial opportunity for private equity. We've touched on a couple of these points so far, but PE firms have the luxury of a typical 3 to 7 year hold period and an ability to focus primarily on value on exit rather than short-term financial results. And I think those two components, that the longer hold period and that ability to focus on the long-term financial results on exit, provide PE firms with just this unique opportunity to deliver and just report on change. And so theoretical example I come back to when I think about this stuff is, if you have a portfolio company which pivots towards using recycled packaging, Now, perhaps that initially increases its operating expenses, but the private equity firm may have in mind that that's worth it, given the long-term trend towards sustainable businesses being more highly valued on exit. So operating profit in the context of a few weeks or months is less relevant than that goal right at the end. And I think what that does is it provides PE managers with this opportunity to focus on the opportunities that arise in the kind of transition to a low carbon and more inclusive economy. And if you take that thought and then juxtapose it with the investor class increasingly pivoting towards ESG and impact, PE firms pursuing that strategy just have an opportunity to be prioritized by those sorts of investors wishing to commit capital. Just a couple, I'm a Welshman, so I will go back to this example, but just a few weeks ago, the Clwyd County Council Pension Fund announced that it now intends to allocate its private markets allocation of its portfolio solely to impact and sustainable investing. And I guess my point is that if private equity is uniquely dispositioned to pursue those kind of strategies, it can be top of the market with respect to investors who are wishing to commit capital to those kind of strategies. So lots and lots of different strategic reasons, but a key one, I think, is that there is a huge opportunity for PE firms operating in this space right now and over the next 5 to 10 years and beyond.
Yeah, I'd agree with that, Danny, in that I think the private markets is much more patient capital. We are ultimately trying to do something that is a bit innovative. We can't keep investing in exactly the same thing as we did before and expect outcomes to be different. So I think that's the benefit of private equity. It can then take that greenfield approach to things, because in some cases these new approaches, technologies, services take years to develop, but ultimately they then have a huge amount of impact at the back end of it. So I think that's why I'm most hopeful that private equity is the natural home for this type of approach, is that it is patient, it can create ultimately the additionality that we need. And as we talked about it, it also comes from the fact that there's a huge amount of control. We can put the right people into the businesses. You put the right CEO, it cascades down into the business that sustainability is really important. So they're the sorts of things that I think it is a fantastic opportunity for the private markets and then therefore for allocators to really support the right people that are going to be making these sort of changes.
Yeah, I wouldn't add anything. I think those are the key things, basically, the patience, the control, and I would say, related to the control, there's the capacity of having an impact and also the access to information, right? So yeah, I totally agree.
Perfect. And another question that's come in, there's a lot of focus on voting in the public equity space. In private equity, what are the equivalent measures you can use to demonstrate the impact of your engagement with portfolio companies?
That's a good question, because I think, the equivalent to the voting part is our, I normally try to say, well, we set up the boards. So it's not like it's, that we vote in an agenda. It's more like we set up the agenda, right? So it's hard, if you want to put it in, if you want to quantify it, how many votes did you have against or for, some sort of ESG, then that's impossible. But I do think that you can put it on the impact terms. So how much impact you have created, both on the ESG side and in the business model side of things. And in those cases, defining the right KPIs, it's even more important. But yeah, unfortunately, there's no such a thing like the voting in the public space.
Yeah, which is good. That's why we can actually affect change. Yeah, because as you said, we control the boards. We generally appoint the chair. We appoint most of the NEDs. You have a whole bunch of reserved matters that actually really do allow you to properly control the business in terms of behaviors that you don't particularly want. Yeah, every single one of our investments, we put in a diversity and inclusion policy. We put in a sustainability policy. We mandate all those things as part of the articles of the company, which I think is the power of private capital.
Yeah, I agree with that. And I think, Peter, you made this point earlier, but the private markets are uniquely dispositioned because we have this significant influence over the investee company. And moreover, there's the financial incentive to seek to affect change, as I was kind of talking about earlier, where if sustainable businesses are more valued, a private markets investor with a controlling or at least significant influence stake has a vested interest in making that investee company seek to achieve those ESG goals. And if you contrast that to private markets, obviously there's no one size fits all, but the portfolio the shareholding may be smaller, the portfolio may be more diversified. Public market investors may lack that same influence that we have in private markets, and they may candidly have less of a financial incentive because their exposure to that entity is just smaller. So I think private markets can have an edge in this space.
Brilliant. And to what extent do you think nature and biodiversity is going to become part of the ESG considerations in private equity? And what are the challenges here?
Yeah, I think this is a huge area. We think nature-based solutions have an immense opportunity to create change. There was a great report done by some Oxford scientists a few months ago that looked at the total quantum of impact nature-based solutions might better have. And if the globe did it properly, it's equivalent to 10 gigatons worth of CO2 savings per year. That's 44,000 gigawatts worth of solar. Or to put in a landmass perspective, that's like covering, I think it's Canada and India in solar. So yeah, nature-based solutions, I think, are part of where we're going, and the UK is bringing forward legislation as part of the Environment Act, which is going to require biodiversity as part of that. And then I think connected to that, you've got a lot of people looking now at this corporate natural accounting and their impact on the nature around them. And I think, yeah, it's going to be a big part of where we go next. The Descriptor report came out with some really good ideas as to how we can try to affect change in nature. So yeah, I'm really hopeful that this can be a new asset class, can be a new area of future investment.
And even when it comes to mitigating the impacts, I mean, of our businesses in biodiversity, I mean, at the end of the day, when we think about climate change, the way that it materializes, or the way that we see it the most, is by the impact that we have in nature, right? So I almost see it as the natural continuation of all the efforts in climate change, rather than two separate things. And it's definitely going to become more important. I think what's going to be challenging, or it's going to be interesting to see, is, I think on the carbon side, it's quite easy because these are almost outcome related metrics, right? But these are, then when we think about the biodiversity, this is the impact that we have on nature. And that's going to be easy to link it to companies whose business model has absolutely no relationship with biodiversity, right? But they have a lot of impact on the emission side. So I see them connected, even for businesses that are not related to that, but it's going to be hard to make that bridge.
Brilliant. And we've had another question come in. Are there any quantitative metrics we should look for at the fund level rather than the company level to measure ESG?
It's a really good question. I think if it's an impact fund, it's easier, because then you can actually say, well, what's your goal and what you're trying to achieve, and you can put a metric to it. But when it comes to doing business responsibly, so more on the ESG side, it's kind of hard. And this is, going again to SFDR, going again to TCFD, it's good to have these frameworks because at least you have one set of KPIs, right? But I would say if you're an Article 9 fund, then it's easier because you have a clear objective, while if you're an Article 8 fund, then basically it's about embedding this in your processes and not necessarily having something. So it's a good question, but not an easy one. I guess it would be a set of metrics so that you can look at the holistic ESG performance rather than one figure.
Yeah, it's certainly hard. Not being a fund-to-funds allocator, I'm not exactly sure how one would do it, but just thinking about it as a fund manager, I think you'd be wanting to think about, well, what is the manager actually saying they're going to be trying to target? And if they are saying they're going to do something, measure that. And that should be fairly quantitatively pure. And I think that's the best you can do for now, because there isn't a universal metric to try to apply, I suppose, a grading of these different managers and how they're performing against their plans. I think also allocators or LPs need to think about what they want, and you need to almost work backwards from that, because ultimately you've got probably goals that you need to try to achieve that need to be met, and that's where you'd want to try to find managers that can help provide specialist solutions for that, I suppose.
And are you seeing GPs commit to Paris or net zero, or are we too early?
Yeah, look, I think most GPs have committed in some way. Certainly we have as Gresham House, and I think everyone has an indication of where they want to go with it. I think it's almost necessary to do business these days if you're wanting to work in this field. I think now it's more about what are you doing beyond that is probably more interesting.
I agree on that. Everyone is making those commitments, but I wonder if they know exactly what they're getting themselves into. So I agree. And in our case, we are committed to aligning our portfolio for the Paris Agreement. And I think, as Peter said, it's a must-have these days. And also it's the right thing to do. But at least in our case, we're taking a year now or two to actually explore what it means, because it's not clear, what are the business implications of this? You need to do it, but you need to do it in a smart way, going back to our, what we said in the beginning around the fiduciary duty and how we provide the returns, right? So once we figure it out, you can actually go to your clients and have a view on, if there is a trade-off or not, and then how you're going to achieve it instead of just making a promise. So yeah, I'm seeing a lot of people going that route, but I'm not sure how many people are actually taking a step back and thinking about it in an active way. Yeah, that's just my reflection, Sally, from what you said.
And I think it depends on how new your business is and how much your business has been connected with some of the less good industries, because there's still trillions allocated to quite dirty industries that, if you've funded that, it's quite hard to unwind, and you obviously don't want to unwind quickly, otherwise, as you say, it has quite catastrophic impacts on your business. So I agree that it's probably not that well thought through in some cases, but I think everyone does need to start really focused on it. It is a hard transition. I think this is going to precipitate quite a lot of unintended consequences and changes. Even just I saw in the FT today talking about all the opportunities within picking up fossil fuel assets out of the oil majors. There is going to be people that really see this as the opportunity of a lifetime in some respects.
Yeah, exactly. But as any opportunity, I guess what I'm saying is that, you just have to be smart around it and see how you approach it, because as much as we all like the smaller businesses and smaller solutions but when you think about the investable universe, I mean, you're actually making a positive contribution if you're investing in something and transforming it, right? Rather than, for instance, excluding. But if you go all in excluding things that are not, environmentally friendly today, who's going to be responsible for changing them into a more, but it's a stance that you need to make, and it's a process that each investor has to go through. I don't know who it was that said, we need to think about what what you stand for and what the objective that you want to, what is your objective, and then start from there.
Brilliant. Another question. Does the panel believe that there is greater scope to achieve additionality in private equity than in public markets? And is additionality in impact portfolios important, or is it intentionally sufficient?
I'll start quickly. You sound like you've got something good as well, Carmela, but I do believe, I think sort of extending out the sorts of things that we were talking about earlier, I do think private markets have the ability to create more impact here, simply because the capital is more patient and we're able to have more control. If you look at the infrastructure space, for example, in our sector, you really can't get into greenfield assets properly. The public market just doesn't allow you to have the 3 or 4 year yield holiday that you want to go and develop these things up. So I think the only way that you can really affect change properly is probably through private markets in developing some of the underlying assets or businesses that will then ultimately become the public market businesses that have sustainability at their core. I think it's I still can't see how the public markets can create that really early stage opportunity well, but then over time, yeah, they can really be quite impactful. Like even something like an Uber never really talks about the fact that they're aggregating transport and taking people off the roads, but yeah, that does have quite a big sustainability impact in some respects that isn't really that well focused on, but yeah, there are benefits there, and that scale does help. And ultimately, public markets are there to create scale, and that's what we really need to have ultimately.
Yeah, I mean, there's not much that I could add to that. I definitely agree. I think maybe think to what you said about Uber. I think, and linking it also to what Peter said around the trends, right, and the business opportunities. I think when you think about new companies and new solutions, they kind of have sustainability embedded into them, right? So there is an additionality because they're trying to solve problems that are related to sustainability already. And there is additionality embedded into that, right? I think there is additionality even with traditional businesses that may have been there for many, many years. When you think about us buying, a family-owned business, right, and professionalizing it, this will have an impact on sustainability as well, because just as you would, we did it with a restaurant chain that we bought a couple of years ago. We had systems so that they could track better their sales, but they also could use them to track better their waste and improve that they had, their sorting so that they didn't throw away so much food at the end of the day, right? So there is an additionality just because there's this entrepreneurial angle to private equity around, also improving the way that businesses are done. And then that automatically creates additionality because you are improving businesses and you're just making companies more efficient.
Perfect. And we'll wrap up with one last question, sort of blue sky thinking. Where do you see ESG and private equity going in the next 5 years?
I can start on that one, which is I think impact strategies were once, as a couple of people mentioned on this call, were once a niche, whereas I think they are now increasingly part of the mainstream, with a series of firms having launched dedicated vehicles and dedicated strategies. I think it will be interesting to see where we go over the next 5 to 10 years. I'm sort of a naturally risk-averse lawyer, but I'll venture to say that I think there's a good chance that impact investing will continue to increase in importance. And I think, as many people think, impact investing could become the mainstream. And I have in mind when I make that comment something that was in the press a couple of weeks ago, where an MD at Advent was saying, actually, we don't propose to launch a specific impact fund because sustainability, we want sustainability to be the core of every private equity strategy that we run. We want us to be about sustainability rather than sustainability to be a kind of side hustle. So I think that, plus the kind of legal developments, regulatory developments, and political focus, is all pushing that kind of agenda, a redirection of capital to be part of the solution rather than the problem. Time will tell whether it becomes the norm, but I'd venture to say it has a good chance.
Yeah, I tend to agree, and I would say, hopefully in 10 years from now, I don't have a job anymore, right? Because everyone is embedding this. I think in 10 years you will not have such a thing, this thing of sustainable investments or impact, and everything will have to consider, every investment will have to take into consideration ESG. Everything will have to consider the impact. So if we think about the spectrum, right, everything will be at least in the ESG integration bucket. But just because it's a way that business must be conducted. So that would be my take to add to what Danny said.
Yeah, I totally agree. It's got to be part of everything. I think that being said, though, yeah, there is, if you look at various different studies, it's $100 trillion globally to decarbonize us properly. $100 trillion, that's a massive opportunity. Even in the UK, it's $1 trillion plus to decarbonize us. And yeah, to me, that then says, hopefully we can mobilize enough capital in the next 5 to 10 years to actually do that. Because I am a bit worried that there isn't enough focus on it yet. So I just hope we get more of this approach where people are thinking about that impact and that they are focused on making change. So my hope is that in 5 to 10 years, it has become completely normal. We've deployed that amount of capital in to make a difference, and we're living in a world where we don't have to worry about what we do on all fronts in terms of nature and climate and across society.
So just thinking about that, I guess, my hope is that it doesn't just become about disclosure or doesn't just become about good intentions. A lot of the developments over the last few years from policymakers have been to, the kind of buzzword is internalize externalities. So to make harmful activities on the world affect one's bottom line, either by outlawing it or by increasing taxation in relation to them. And so I guess if we see that trend develop, if we see that trend continue, that trend to internalize externalities, it may be that high impact pays and negative externalities just don't. And so it may be that actually there is a real financial incentive to move forward with this, which I think is echoing what Peter was saying.
Brilliant. Thank you all so much. This has been a great panel and a great session. So thanks, Peter, Carmela, and Danny, and thank you everyone for tuning in. Once again, thank you to our supporting partner, AIMA. And if you've enjoyed today's session, remember to register for our other events this week. Tomorrow we'll be covering private credit, and on Thursday we'll be discussing real estate. There will also be a survey circulated after this session. This is the first time we've run Alternative Investment Week, so we'd love to have your feedback, and it would be great to hear your thoughts. But thank you for tuning in, and see you soon.